Oh, I don't hear anything. You hear anything? That's right. We told you it was coming. Music stopped. Music stopped, everybody. Yep. The hype cycle is coming to a close. Just like we told you it would. Welcome, everybody. The hype cycle. Yeah. The world of the neighborhood of make believe there, King Friday, and all startups go to the moon and the sky, and it's wonderful. And I'm going to Silicon Valley, and I'm going to get myself some venture capital money. I'm going to get funded. I'm going to hype the thing up, and I'm going to take it public. And when I take it public, I'm getting the hell out, along with all of my VC money. It's over. It's over. That's right. Anyway, Janet Yellen, banks are just fine, she says. Banks are just fine. How much credibility does Janet have? About as much as Joe. Much as Joe Biden. Yeah, we heard from him last weekend. I don't know where he is. He's cleaning his aviators or something like that. Take a look at the banking stocks. Crash, bang, boom. Guys, you can't fix it. You can't. It's going to work its way through. Everybody, all the gunk needs to come out. I described this years ago when was asked about market dislocations, recessions, bear markets, and I compared them to the lymphatic system of the human body. Necessary. It's necessary. We get through all of this crap, get rid of all of this gunk, all of these companies out there that were accessing our capital markets, gobbling up all of this money. They're useless. They were zombies from the get-go. They weren't companies. They were marketing ploys. That's all. Marketing ploys. Let's try to make something look clever so then we can get the public to buy our dog shit. Yeah, the musical chairs bit that I did, I was actually done. It was done in the movie Margin Call, which I happen to be a big fan of. Great business movie going back to the financial crisis. We had Jeremy Irons basically tell his board of directors at a big investment bank that, they asked the question, why do they pay me the big bucks? It's not because I'm smart. It's because I know when the music's going to stop. And right now, I don't hear anything. I don't hear a darn thing. And there is a scrambling out there at Silicon Valley. And there's a lot more of a reckoning that's going to take place. Can take place in commercial real estate in many of these areas, San Francisco, Silicon Valley. There's going to be a fallout. No doubt about it. But again, we told you it was coming. I mean, I'm starting to see funds now, more and more funds. Well, we've always made fun of SoftBank here. Tiger Global marking down the value of their investments in private companies by 33%. Keep writing it down, big guys. Keep writing it down. A game of IPO musical chairs is over. And actually, they're writing stories about it now. Some of the big publications, I guess they've been listening to the podcast here. I saw this one today. The market for initial public offerings has been frozen for more than a year. No kidding. No kidding. Wow. And again, longtime listeners know we spend a lot of time here making fun of IPOs. People get mad. Oh, you're talking down these companies. What? What do you think? I'm Bill Ackman? You think I'm going to go on CNBC and I can just wreck something? No. If the company's garbage, the company's garbage. If it's a great company and I come on the program here and I call it garbage, I'm going to be wrong. The market eventually is going to be right. Again, that's how the world works. You got a great idea, you got a great company, it's going to work out. But yeah, going after all of these garbage IPOs and what's going on. The increase in capital costs over the past years resulted in a drop in the valuation of unicorn companies. Again, all of these companies that these venture capital companies have been pouring money into, laddering these companies. Every round of financing, let's say there was an initial round of financing at 10 million. And then they company goes along, they're able to market and get the name out more. They bring in more money. Oh, next round of financing is at a higher valuation and they raise another 50 million. And they keep doing this again and again and again because they're saying we're going to keep growing and we're getting this big name and we're going to get ready to take the company public. And that's when all the VC money, that's when all of those initial rounds of financing, that's when they sell. That's when they stop giving a shit about what the company is doing. It doesn't matter to them anymore. Anyway, situation right now poses a problem for venture capital funds that paid record high prices for these companies. They can't afford to offload their positions to retail in the secondary market. These are the same guys that are going on TV telling everybody how wonderful they are and how great they are for the entire world. And the U.S. economy is going to collapse without their infinite wisdom. That is the biggest bunch of horse shit ever. That is the biggest bunch of bunk ever. You have a legit company. Guess what? You will find financing. Like I said, I made fun of this yesterday on the program. They got a freaking television show on CNBC, Shark Tank. If you have a good idea, it will get funded. Period. The end. You got a business plan. Remember that scene in Entourage? Again, great film. It's a great scene in Entourage where the character Turtle is going into Ari's office and he wants money. He wants money because he wants to start this business. And Ari just goes off and basically said, what is your business plan? Lays all of these things out, everything that needs to be done. He says, you get that done and you present something to me, then come back to me. That's all it takes. These venture capital companies, they don't give a darn about the long-term prospects. They just want their money out. Little to no difference between what they do and what Jordan Belfort did. And that's just the reality. And here, when you're not able to exit these companies, the whole thing falls apart. It's a bigger systemic problem, said Chief Executive Robert Coate of Coate Capital. Bloomberg data reveals that IPOs have only managed to raise $2.4 billion in 2023. We went over that yesterday in the program. It was about 27 IPOs, I think, so far this year. 43% lower than the annual amount raised at this point last year. 95% plunge from the $48 billion raised during the same period in 2021. Turmoil in the IPO market is creating problems. We've been stalled for more than a year. Caught people off guard because they didn't expect to have the ability to IPO in this amount of time. Startups are structured with the intent of going public or being acquired. However, when funding sources dry up and avenues to the secondary market become more challenging to navigate, the cycle of investment and growth grinds to a halt. This puts startups with weaker financial balance sheets at risk of bankruptcy. So venture capitalists who overpaid for these companies are going to get hit. So Do you think that any of these companies that have legit value, you think they're going to have a difficult time finding financing at all? Well, what you think that a big investment bank, if you got a high quality business plan, you think they're going to show you the door if they see an opportunity to make money on something of high quality? No. See, this is not the problem. There's not as much crap that's out there. We're not going to be dealing with as much crap. We're going to be dealing with higher quality companies. And you try to explain to me how that's a bad thing. Anyway, bank sell-off rolls on. And it's going to continue to roll on. And we're going to have fits and starts, and there's going to be good days, and there's going to be sell-offs, because, again, nobody knows where the bodies are buried yet. Well, some people might, but there are plenty of them out there. There are plenty of them out there, and they're going to be dealt with. Money keeps flowing out of banks. Several weeks ago, we mentioned this on the podcast, mentioned on the radio show, on my website, WatchDogOnWallStreet.com. We put out a little jump page for everybody there where we were saying, hey, don't let your bank control your money and interest. And what we were doing, this is before everything started blowing up, said, hey, listen, get your money out of the bank. Okay, what we'll do for you is no fees, commissions. We'll get you in T-bills. And at the time, what did we put up there? At the time, it was, what I say, 3-month 5.02, 6-month 5.3, 1 year 5.24. Not too bad. Not too shabby. And guess what? The money is flowing out of the banks, and we're doing this for people all over the country. It's going to continue. So what? So why money didn't go to money heaven? High quality banks are going to obviously have to adjust what they're paying out in interest. Is that so bad? No. Will smaller banks have a difficult time with profitability? Absolutely. Absolutely. It's going to change the dynamic. It's putting you back in the driver's seat. Not necessarily a bad thing. With all of this money flowing out, I talk about not knowing where the bodies are buried. There's going to be a lot of hush-hush around this. Again, we talked about the utter stupidity of Goldman Sachs, the vampire squad. Again, I can't, it's wrong. I'm sorry. Utter stupidity. And again, stupid is as stupid does, but Goldman Sachs, there may have been a method to their madness. Who knows? That was the point that I was making yesterday. But let's just pretend that they're not smart over there and they did what they did. It was just plain dumb. Letting the cat out of the bag, scaring the hell out of depositors, and that's why there was a run at Silicon Valley Bank. But again, expect, it's going to be a lot of quiet from these banks, but they're making phone calls. It's going to be, again, it's going to be a busy weekend. It's going to be a busy weekend, and we're going to see some shotgun weddings. You're going to see some companies, banks that are put together. There's no doubt about that. It's going to happen. What I would basically recommend to people is don't get into that. The media. Get ready, set, panic, everybody freak out. Last weekend on the Sunday talkers, the business programs over the course of the weekend, they were basically predicting Armageddon this week. And to be honest with you, they want it. It's great for ratings. It's great for ratings. When there's market crashes and there's sell-offs and there's panics, they can get out all their cool graphics, and it's great for business. Much easier to sell advertising at that point in time. They're rooting for it. They're rooting for it in this, the same way, they get all excited at the major networks when a massive hurricane collects itself off the Florida coast so they can send some people down there to, wear T-shirts and stand out there in the middle of a storm and the wind's blowing like, shh, it's getting real windy out here. Shut up. Same thing. Okay. They like the panic. They like getting the people going. Don't play into that. Okay. Well, we're going to see fits and starts and ups and downs. It's all going to go by the wayside. Well, you think the financial system is going to collapse? No. Quality, my friends. Quality, baby. I told you about the 3 little pigs. You want your portfolio built with bricks. You want it built with bricks. And in fact, now's the time to continue to build on your portfolio. Like I've said again and again, this is where money is made. And I'm going to be honest with you. I mentioned about the normalization of interest rates. Song popped into my head today. Classic. I don't know if it came out in 1989 or 1990. It was this R&B group, Soul to Soul. They had the song Back to Life. Back to life, back to reality. I am so excited. I am so excited that we're not going to go. I'm hoping we do not go back to the free money days. I am thrilled. Again, my job was much, much more difficult. The amount, because again, when you have free money days, everybody thinks the party's on. But again, you're swimming in a cesspool. I have to look through so much crap, literal crap companies. Yeah, the time that I had to spend here on the program and with people and talking about Beyond Meat and all of this. I can name one after another. I don't want to deal with that anymore. I want money to flow to the right places because that's what creates real growth. I want to talk about this quickly as well. And again, this doesn't surprise you. So how bad it is. This is just another quick story. Some of these tech startups, they're actually, Silicon Valley Bank is in receivership. Their holding company declared bankruptcy today, but some of the companies that pulled their money out of Silicon Valley, like some of these startups are getting phone calls saying, hey, you better bring your money back. You better put those deposits back in the bank or else. And what's or else? Yeah, some of the credit lines and banking products that Silicon Valley Bank provided these startups. Well, if they don't keep their money there at the bank, they made them sign deals where it was like, hey, listen, if we're going to give you this credit line, we're going to do this for you. You have to do all of your banking with us. Yeah, and they signed on. You'll get great interest rates, great. Sure, why not? Yeah, now Silicon Valley Bank, which is in receivership right now, is calling up a lot of these startups saying, you better put your money back. Anyway, we're doing various different topics in today's podcast. It's going to be a little bit longer today. And I was thinking about it because I'm getting emails from, let's say I get stuff from various different asset managers out there, stuff that's happening at certain firms. The woke asset managers, I was thinking about it, if it was like a Saturday Night Live skit and you were to grab all these woke asset managers and you were to do the conversations that are taking place, that could take place if you piled them all together and think of a break room, with coffee machines and the corporate refrigerator there. Think of something like the television show, The Office, and all of these woke asset managers that have loaded up on all of these woke companies that are falling apart. Could you imagine the conversation, the things that they're saying? Well, they're freaking out. But again, don't worry. They don't have to worry because Biden gave them a get out of jail free card. Okay, a get out of jail free card. Doesn't matter how poorly you guys do. As long as you're woke, it doesn't matter. You can lose your clients as much as you like, as long as you're woke. Again, you don't believe me? Look it up. that was signed into part of the ERISA rules. That was right before Thanksgiving, if I'm not mistaken. It was like the day before Thanksgiving. I think maybe the Wednesday before Thanksgiving, or maybe the Friday after Thanksgiving, they put that into place. Anyway, First Republic. People familiar with First, but again, it's a San Francisco-based bank. They have branches all over the country, and you see it. I'm sure most of you out there don't have an account there. First Republic Bank. First Republic Bank is it's a bank for the people that are part of George Carlin's big club. You know that whole skit he does, big club, you ain't in it. Well, I ain't in it, you ain't in it. It's the bank for very, very wealthy people, very concentrated in that business. And again, they have an enormous amount of unsecured depositors. Again, same type of deal that Silicon Valley Bank was offering. See, First Republic offering, with wealthy, offering loans against stocks for certain people. You kept your money, a certain amount of money there. They would, mortgage rates. Oh yeah, people, when you take a look at mortgage rates that you see that you and I would pay, really, really rich people don't pay those rates. They don't pay those rates. They cut deals with their bankers. Again, this is one of those banks that was heavily involved with that. And because they have so much in regards to uninsured deposits, basically they're going after a bit of a run. Some of the big banks put some money, deposited some money there to keep it afloat. And again, they're circling. They're circling. They're going to go round and round and round, watch the stock drop, and then they'll step in when the price gets down to a level where they think it's reasonable. One more quick story I wanted to cover today. There was an editorial today. Kevin Green and John Michelson, Wall Street Journal. Green is chairman of the Tassett Group, and Michelson's chief investment officer at Michelson Capital. And they're talking about the need in this country for small banks. And their concern is that with the collapse of Silicon Valley, we're going to have more consolidation here in the United States, and we're going to head toward a more European-style banking system. And we do not want that. We don't want that. Makes it much more difficult. I mean, you can, but it makes it a hell of a lot more difficult to get access to capital. And we don't want that. We want to have small banks. We want to have community banks. And again, part of the problem, why so many banks have been dissolved, why so many banks went away after the financial crisis, wasn't because they went under. It was because of the Dodd-Frank regulations that made it too expensive for them to do business. I'll even put this into perspective for what I do. Started this company 30 years ago. Okay, right around 30 years ago. And, again, from scratch. And I only had a certain amount of capital available to start it. And there was regulatory costs that were involved. You take a look at what I'm paying today, adjusted for inflation, it's insane. It's insane. And I made this statement before. I want small business. I love startups. The majority of the clientele that I have, small business owners around the country. I couldn't afford, it would have never happened. If I tried to start Markowski Investments today with the capital I had, adjusted for inflation, I would have said no. I would have done something else. I would have said, this is impossible. This is impossible, at least the way that we did it. Close to impossible. I don't want to say anything is impossible. But it's just a much longer, much more difficult road, and it's due to regulatory costs. Many banks, after Dodd-Frank, said, hey, you know what? We can't afford to do this. They'd either close up shop, sell themselves to someone larger, and we saw many of these small banks go away. Again, regionals are getting hit, and I do believe if you mismanage your business, guess what? You need to get eliminated. I don't have any problem with this. Where I disagree with these guys. I think that you're going to see, other types of lenders that come out of this. I mean, we've always dealt with bank failures here in this country. It's nothing new. I mean, the S&Ls, which were not banks, they had a separate regulator back in the 1980s. What was about a third of them failed. A third of them. It was a similar type of a situation. Over 1,000 institutions, S&Ls, failed back during the 1980s. And I do think we're going to continue to see more failures. But again, it also offers up opportunity. I think the best way, and I've said this from the get-go, is we need to go back. We need to go back to the days when commercial banking and investment banking were two separate entities. Again, good luck with that. I mean, banks have become behemoths, but wouldn't you take a shit ton of risk out of the system if you separated those two entities? You want to be a commercial bank, you be a commercial bank. You want to be an investment bank, you want to be an investment bank. I would also, like I said, I wouldn't even allow asset managers to be under the same roof. Separate it all. And let's think about it like this. Again, you got a massive company, too big to fail, J.P. Morgan. And you take a look at the valuation of that company. And obviously, their stock has come down. It's kind of underperformed over the past couple of years, but one can agree it ain't going anywhere. How much do you think that company would be worth if you broke it up? You separated certain parts. I mean, it'd be worth a hell of a lot more, quite frankly. Now, granted, again, company wouldn't be doing the same numbers, and the executives that we wouldn't need, executives wouldn't be making as much money because revenues would obviously be lower because it'd be different entities. But separation is good. It's just like checks and balances. When they eliminated the Glass-Steagall Act and they allowed for these big banks to come together, these financial supermarkets, again, it wasn't good. Wasn't, and again, you take a look, it worked. Glass-Steagall legislation, it's back from the 1930s. The bloody thing worked for 70 years. Almost 70 years. It worked fine. But again, Republicans, Democrats, big banking lobbyists, they saw dollar signs is what they saw. And again, this is what we have today. Anyway, all right, we're gonna go for the day. And I want to remind everybody again, my big terrestrial show will be posted up on the podcast this weekend. We'll do a lot of interesting financial planning topics, whatnot going. Again, rundown of what we've covered over the course of the week. I invite each and every one of you to get to our website at WatchDogOnWallStreet.com. See what we're doing. And again, let me ask a favor. I love to see my numbers go up. I do. Who wouldn't? More and more people listening to the program, getting themselves in the know. Share the podcast with others. Let people know about it. That's how I grew my radio show from a couple of stations to hundreds. Again, it was word of mouth. WatchDogOnWallStreet.com. WatchDogOnWallStreet.com. God bless.